The secret rule that separates wealthy traders from the rest. Have you ever watched a stock soar to incredible heights just days after you sold it for a modest profit? That sinking feeling in your stomach, that voice in your head saying, "I knew I should have held longer." It's the universal experience that haunts traders everywhere. What if I told you that the difference between making a comfortable living and building generational wealth in the markets comes down to one deceptively simple rule? But before we begin, please hit the like button and let me know where in the world you're watching from today. It's always fascinating seeing who's joining us from around the world. And if you haven't already, make sure to hit that subscribe button and turn on the notification bell so you don't miss any of our future videos. Has this ever happened to you? You spot a perfect setup, you execute the trade flawlessly, the market moves in your favor, and then what do? If you're like most traders, you feel that irresistible itch to take profits quickly, to lock in those gains before the market can snatch them away. After all, nobody ever went broke taking a profit, right? Wrong. Dead wrong. The harsh truth is that the wealthiest traders throughout history, from Jesse Livermore to Stanley Druckenmiller, built their fortunes not by how they entered trades, but by how they stayed in them. The most powerful wealth-building rule in trading isn't about finding the perfect entry or having a complex strategy. It's about having the discipline to sit tight when the market is proving you right. Stay with me until the end of this video, because what you're about to discover might completely transform how you approach the markets. This isn't just another trading tip. This is the fundamental principle that separates those who make life-changing money from those who constantly wonder why success eludes them. Think about it. Anyone can spot a good trade. Anyone can execute an entry. But how? Many traders have the emotional fortitude to ride a position through the inevitable fluctuations, doubts, and temptations to cash out early. The real money in trading isn't made in the buying or the selling. It's made in the waiting, in those excruciating moments when doing nothing feels impossible, yet is precisely what the situation demands. Most traders are perpetually caught in a cycle of activity, believing that more trading equals more profit. They jump in and out of positions, snatching small gains, while the truly monumental moves slip through their fingers. They mistake movement for progress, action for achievement. What they don't realize is that sitting still at exactly the right time is often the most profitable thing you can do. The market has a cruel way of testing your resolve. Just when a position begins showing promise, it throws a reaction your way. Not enough to invalidate the trade, but just enough to make you question yourself. And in that moment of doubt, your true character as a trader is revealed. This is where the transformation happens, where you either succumb to the psychological warfare of the markets or rise above it. If you've found value in these trading insights, hit that subscribe button now to join our community of disciplined traders. Every video brings you closer to mastering the market's true rhythm. Now, I want to go even deeper into this topic by clarifying something that trips up countless traders on their journey to mastery. There's a fundamental distinction that needs to be made between speculation and investment. These two approaches to the market might seem similar on the surface, but the mindset behind them creates entirely different outcomes. An investor hopes the stock will pay forever. They're looking for companies to hold for decades, collecting dividends and watching their capital slowly compound. A speculator, however, rides the move while it lasts and exits when it's over. The revelation here is that many people fail because they confuse these two mindsets, trying to apply investment thinking to speculative positions or vice versa. The hidden truth is that you're not meant to marry a stock. The relationship between a speculator and a position is conditional. You stay with it as long as it's acting right. When the behavior changes, when the story that brought you in no longer applies, the decision becomes clear. This isn't about emotional attachment. It's about recognizing patterns and respecting what the market is telling you. Behind the scenes of every great trader's success is this uncomfortable reality. The market is ultimately a battle of nerves. The weak are always shaken out before the big moves happen. Think about that for a moment. It's almost as if the market has an intelligence of its own, designed to transfer wealth from the impatient to the patient, from the emotional to the disciplined. The impact of this principle goes far beyond your trading account. It shapes your entire relationship with uncertainty and risk. When a position is moving in your favor, your greatest enemy isn't the market, it's yourself. It's that voice whispering, "Take the profit now before it disappears." It's the fear that morphs into regret when you sell too early and watch from the sidelines as others ride the move you identified but couldn't stay with. The market doesn't reward the timid. It pays those who can wait with iron patience, who can sit through the noise and volatility without being moved. This isn't just a trading principle. It's a life philosophy about delayed gratification and emotional regulation that separates achievers from dreamers in every field. What makes this journey so challenging is that it runs counter to our hardwired instincts. Our brains evolved to seek immediate rewards and avoid uncertainty. Yet the market demands exactly the opposite. It rewards those who can embrace uncertainty and defer gratification. This is why most fail, despite understanding the concepts intellectually. The battle between discipline and emotions is fought not on charts or in economic data, but in the silence of your mind as you watch your positions fluctuate. It's in those moments of doubt, those internal conversations that no one else hears, where fortunes are won or lost. Drop in the comments "iron patience" if you've experienced that battle between taking quick profits and holding for the big move. I want to know I'm not the only one who's had to learn this lesson the hard way. Let me share something that changed my entire perspective on trading. The greatest revelation in my journey came when I finally understood the rhythm of the markets, a rhythm that most traders completely misinterpret. Here's the hidden truth that took me years to discover. Big moves don't happen in straight lines. They never have, and they never will. What we imagine as the perfect trade, a smooth, upward trajectory after our entry, simply doesn't exist outside of our fantasies. The reality is that markets wiggle and shake, creating an intricate dance designed specifically to test your resolve. These movements aren't random, they're purposeful. They wear you out mentally, making you doubt your position before the real move has even begun. Think about the psychology behind this pattern. The market has an uncanny ability to shake out the weak hands right before the biggest moves occur. It's almost as if there's an intelligence behind it, orchestrating these fluctuations to ensure that only the most mentally prepared traders capture the substantial profits. This isn't superstition, it's the observable pattern that repeats across all markets, all time frames, all throughout history. The breakthrough comes when you start viewing these shakes not as threats, but as confirmation of your analysis. When you learn to recognize this pattern, you save yourself from being tricked out of profits time and time again. It's a complete mindset shift from seeing volatility as your enemy to recognizing it as the necessary prelude to the moves that build fortunes. Now, diving deeper into the anatomy of these market reactions, they aren't accidents or anomalies. They're an essential, natural part of any significant move. When a stock that has been climbing strongly suddenly dips slightly, it's not a flaw in the system. It's the system working exactly as designed. What happens in those moments reveals the true character of most market participants. The vast majority panic and sell, convinced the move is over, only to watch in dismay as the stock resumes its climb without them. They interpret these reactions as warnings when they're actually tests of conviction, of understanding, of patience. Behind the scenes of every major market move is this filtering mechanism that separates those who understand the nature of markets from those who don't. It's like a secret password that grants access to profits that most traders will never experience. The password isn't some complex technical indicator or insider information. It's simply the understanding that these reactions are normal, expected, and necessary for the market to continue its trajectory. This perspective transforms your entire approach to trading. Instead of fearing pullbacks, you begin to anticipate them. Instead of being shaken out by them, you prepare mentally for their inevitable appearance. You might even welcome them as opportunities to add to winning positions at better prices. The journey from fear to understanding doesn't happen overnight. It requires experiencing these patterns repeatedly, sometimes painfully, until the lesson is fully internalized. But once this shift occurs, the market never looks the same again. Type Shakeout Master in the comments if you've started recognizing these patterns in your own trading and are working on holding through the inevitable shakeouts that come before big moves. What I'm about to share with you now reveals the deeper mechanics of what's actually happening during these market reactions. This is the phenomenon I call the great transfer of wealth that occurs in plain sight every single day in the markets. When you truly understand this process, it's like witnessing the invisible hand that moves capital from one group of traders to another with remarkable efficiency. Here's what's really happening. Every reaction in the market represents a transfer of assets from weak hands to strong ones. While the public panics during dips, selling their positions out of fear or uncertainty, experienced operators are quietly accumulating more. They're not just holding, they're actively buying what others are desperately selling. The revelation here is that the smart money actually welcomes these shakeouts. They know the fundamental story hasn't changed. They know the move isn't over, and they recognize the opportunity being presented. What happens next is almost mechanical in its predictability. Once the crowd has been flushed out, once the weak hands have surrendered their shares, the stock runs higher with fewer sellers to hold it back. This cycle of accumulation and distribution is the hidden architecture beneath market movements. The transformation occurs when you shift from being the person who unwittingly gives away your shares during reactions to becoming the person who calmly acquires them. This isn't just a trading strategy, it's a complete paradigm shift in how you perceive market behavior. Ready to transform your trading psychology? Subscribe now and build your trading discipline one video at a time. Join thousands of traders who are learning to ride the big moves. Now, diving even deeper into this topic, we arrive at what I consider the most crucial skill in all of speculation, distinguishing between a normal reaction and the end of a move. This is where the journey becomes particularly challenging, where even experienced traders often stumble in their decision-making process. Most traders mistake healthy pauses for final collapses. They see a pullback and immediately assume the worst, that the trend has reversed, that the story is over, that it's time to exit before further damage occurs. This mindset causes them to sell before the real profits appear, surrendering their positions just before the next leg higher begins. Behind the scenes, professional traders have developed an intuitive sense for reading the character of a move. They're not looking at different charts or using secret indicators. They're interpreting the same information differently. They're asking better questions. Is this pullback occurring on lower volume? Is it respecting logical support levels? Is the broader market influence temporary or fundamental? The impact of mastering this distinction can't be overstated. It represents the difference between capturing 10% of a move and capturing 90% of it, between making a living in the markets and building genuine wealth, between perpetual frustration and consistent success. What's fascinating is that this skill isn't purely technical, it's partially intuitive, developed through experience and careful observation. It requires both the analytical mind to assess the evidence and the emotional stability to trust your assessment when fear is suggesting otherwise. If you've ever sold during what you thought was the end of a move only to watch the stock recover and surge higher, type "learned that lesson" in the comments. The path to mastery begins with recognizing these costly patterns in our own trading. Let's explore one of the most seductive illusions in all of trading, a trap that has claimed countless victims across every market and time period. I call it the sell to buy back lower fantasy. This deception is particularly dangerous because it appeals to our natural desire to feel clever, to outsmart the market, to have our cake and eat it too. The market presents us with a seemingly logical proposition: take your profits now and then. Re-enter at a better price when the inevitable pullback occurs. The whisper is always the same: you can sell now, lock in these gains, and then get back in when it dips. This storyline plays out in the minds of traders every day, a powerful narrative that feels both prudent and strategic. But here's the breakthrough realization that changed my entire approach. More often than not, the stock never gives that second chance. It rallies, leaving you stranded on the platform while the train pulls away. The market rarely accommodates your perfect plan. The illusion of control, that you can perfectly time your exit and re-entry, is perhaps the most expensive lesson in trading. This journey toward enlightenment requires accepting a humbling truth: you cannot consistently outsmart the market by ducking in and out. The market is a complex, adaptive system with millions of participants, each making decisions based on their own information and psychology. The idea that you can predict exactly when and where a pullback will end is a dangerous form of hubris. Now, I want to offer you a powerful metaphor that completely transformed how I view market fluctuations. Think of reactions in the market as toll gates on the road to profit. This isn't just a clever analogy, it's a profound shift in perspective that can revolutionize your trading results. Here's the hidden truth: if you can pay the toll, meaning you can stomach the dip without panic, you're allowed to continue the ride towards substantial profits. If not, if you flinch and exit your position, you're essentially thrown off the train. Someone else takes your seat and your potential profits. The revelation here is that these tolls aren't optional. They're mandatory checkpoints on the journey to meaningful returns. Every significant move in market history has included these toll gates. They serve a purpose: to ensure that only those with the right mindset, preparation, and emotional discipline receive the outsized rewards. Behind the scenes, this mechanism creates a natural selection process in the market ecosystem. The traders who understand and accept these toll gates as part of the journey continue along the path to prosperity. Those who resist them, who try to avoid paying the psychological toll, find themselves perpetually starting over, always catching the beginning of moves but never riding them to their profitable conclusions. The transformation happens when you stop viewing these dips as threats and start recognizing them as the necessary price of admission. The shift isn't just intellectual, it must penetrate your emotional response system, rewiring how you react when your positions move against you within the context of a larger trend. Type "pay the toll" in the comments if you've come to recognize these market reactions as necessary tests rather than signals to exit. Let's dig even deeper into the psychology behind these market movements. What makes trading such a unique psychological battlefield is the complete rewiring of instinctual responses it demands from us. Think about this profound mindset shift. Instead of fearing reactions in the market, what if you actually welcomed them? This isn't just positive thinking, it's a fundamental transformation in how you perceive market movements. When a stock dips modestly during an otherwise strong move, most traders feel that knot in their stomach, that surge of anxiety that pushes them toward the exit button. But elite traders have conditioned themselves to see something entirely different. They recognize that the market is simply cleaning house, shaking out weak hands and preparing for the next leg up. This perspective shift doesn't happen overnight. It requires deliberate practice, repeated exposure, and sometimes painful lessons. But once this alternative view takes root, the entire trading experience changes. What was once a threat becomes an opportunity. What triggered fear now signals potential. As long as the underlying strength remains intact, that dip isn't your enemy, it's your ally in disguise. Behind the scenes of every great trader's development is this pivotal moment where they stopped fighting the natural rhythm of the market and started working with it instead. It's like learning to surf. Fighting the wave guarantees you'll wipe out, but moving with it allows you to harness its power. Now, let's uncover what I believe is the ultimate hidden truth in trading psychology. The real enemy isn't the market, other traders, or even your own analytical skills. The real enemy, the silent killer of trading accounts everywhere, is impatience. This revelation changes everything when fully absorbed. Market reactions aren't mistakes or flaws in an otherwise perfect system. They're the very mechanism by which the market ensures that only the disciplined and patient receive the rewards. These fluctuations serve as nature's perfect filtering system, separating those who deserve the profits from those who don't. Every time you give in to fear and let a small reaction drive you out of a position prematurely, you're essentially failing the test. And here's the painful part. You're literally handing your potential profits to someone else, someone with greater patience and discipline. This transfer of wealth happens millions of times every day across all markets. The journey toward mastering this aspect of trading is deeply personal. It requires honest self-reflection about your own tolerance for discomfort, your need for immediate gratification, and your ability to trust your analysis when emotions are screaming otherwise. The transformation occurs not when you find the perfect technical indicator or trading system, but when you develop the capacity to sit through uncertainty with calm conviction. This path demands a fundamental rewiring of how your brain processes market information. Instead of reacting to price movements with instinctive fear, you train yourself to evaluate them objectively, to distinguish between normal volatility and genuine warning signs. This skill, distinguishing signal from noise, represents the ultimate edge in markets. If you've ever found yourself being shaken out of positions right before they make their biggest moves, type "patience is profit" in the comments. Let's explore how to distinguish between healthy reactions and genuine warning signs. Let me tell you something that rarely gets discussed in trading education. The market isn't just testing your strategy, it's testing your character. This revelation transformed my approach to trading completely. You see, anyone can buy a stock when the story looks compelling or cheer when it rises in a straight line. That part requires no special talent, no unique insight, no exceptional qualities whatsoever. The true test, the moment of truth in every trader's journey, arrives precisely when the market hesitates, dips, or faces negative news. That's when the spotlight turns inward, illuminating what you're really made of as a trader and as a person. In those critical moments of uncertainty, you discover whether you have genuine discipline or nerves made of glass that shatter at the first sign of adversity. This character test occurs in every significant trade you'll ever make. Behind the scenes, what looks like a simple decision to hold or fold is actually a profound revelation of your inner landscape, your relationship with uncertainty, your capacity for independent Thinking, your ability to withstand social and emotional pressure. These qualities aren't taught in trading books, but are forged through experience in the unforgiving crucible of the markets. The transformation that occurs when you pass these tests repeatedly is remarkable. You develop a kind of emotional immunity to market fluctuations that the average trader never achieves. What once triggered panic now barely registers. What once seemed like a crisis now looks like a normal, expected part of the journey. Now, I want to clarify something absolutely essential, a distinction that has saved me from countless costly mistakes. There's a dangerous trap that many traders fall into when trying to develop discipline. They confuse true discipline with mere stubbornness. This confusion has destroyed more trading accounts than perhaps any other psychological error. Here's the critical distinction you must understand. Stubbornness is holding on when the market has proven you wrong. It's clinging to a losing position because you can't admit your analysis was flawed. It's letting ego override evidence. This isn't discipline, it's delusion, and it's devastating to your capital. Discipline, on the other hand, is holding on when the market has proven you right, but your own fear is trying to throw you off. It's maintaining your position despite the emotional discomfort, despite the voices, both internal and external, urging you to take quick profits. It's following your methodology when every nerve in your body wants to abandon it. The impact of mastering this distinction extends far beyond your trading results. It shapes your entire approach to decision-making under uncertainty. Recognizing the difference between healthy conviction and unhealthy attachment is a life skill that applies to relationships, career choices, and personal development. The hidden truth is that most traders never develop this discernment. They oscillate between surrendering too quickly to fear and hanging on too long out of pride. They never find that middle path, the razor's edge of disciplined trading where decisions are made from clarity rather than emotion. If you've ever confused stubbornness for discipline in your trading and paid the price, type "learn the difference" in the comments. Let's explore how the truly successful traders master their emotional responses to market movements. One of the most liberating revelations on my trading journey was understanding the true nature of emotional mastery. There's a dangerous myth that successful traders somehow eliminate emotions from their decision-making, that they become cold, calculating machines impervious to fear and greed. This couldn't be further from the truth. Even after years in the market, even after thousands of trades, fear and greed never completely disappear. The transformation doesn't happen by eliminating these emotions, but by changing your relationship with them. The difference between amateur and professional traders isn't the absence of emotion, it's the ability to expect those feelings without automatically obeying them. This insight changed everything for me. I stopped fighting my emotions, stopped being disappointed when fear or greed surfaced, and instead began observing them with curiosity. The breakthrough comes when you realize that discipline isn't about becoming emotionless. It's about mastering your emotions. It's knowing with certainty that your nerves will scream at crucial moments, but refusing to let them dictate your actions. Behind the scenes of every successful trader's mind is this inner dialogue between emotion and reason. The emotions speak loudly, sometimes they shout, but they no longer have automatic control over the decision-making process. This separation between feeling and action represents the highest form of trading psychology. It's not suppression, it's awareness without surrender. Now, I want to share perhaps the most powerful metaphor that reshaped my entire trading philosophy. The market isn't a sprint, it's a marathon. This simple shift in perspective explains why so many talented, intelligent traders ultimately fail to achieve their potential. Most traders approach the market like sprinters, seeking quick profits, fast action, immediate gratification. They want excitement. They want to feel the rush of victory frequently. They want to tell stories about their brilliant trades at dinner parties. This mindset feels natural because it aligns with our hardwired preference for immediate rewards. But here's the revelation that changed everything. Those who make fortunes in the market are marathoners. They understand that real wealth isn't built through a series of spectacular trades, but through consistent application of sound principles over time. They've developed the rare capacity to maintain their discipline while others drop out, to stay the course while others chase the next hot tip or strategy. The journey from sprinter to marathoner represents the most profound transformation in a trader's development. Endurance in trading means sitting through the wobbles and tests when every fiber of your body urges you to quit. It means accepting discomfort as the price of admission to significant profits. It means developing psychological stamina that most people never cultivate in any area of life. This marathon mindset applies not just to individual trades, but to your entire trading career. The path is long, with valleys and plateaus that test your commitment. The traders who ultimately succeed aren't necessarily the smartest or the most knowledgeable. They're the ones who can endure, adapt, and keep moving forward when others give up. If you found yourself switching strategies, jumping from one approach to another whenever you face difficulty, type "becoming a marathon trader" in the comments. Let's explore how to develop the specific habits and routines that reinforce this endurance mindset.